On September 2nd, 1945, the guns fell silent across Europe and Asia as America emerged victorious from World War II. But there was a catch, a massive one. The United States had spent itself into what appeared to be a financial abyss. The national debt had exploded from $49 billion to $260 billion in just 4 years. That was a five-fold increase. The economists looked at the ledgers and declared the nation was bankrupt. The numbers were unsustainable. No nation in history had owed this much money. Yet something extraordinary happened. Within a generation, American wealth had not just recovered, it had exploded into unprecedented dominance. The United States went from a middling economic power to controlling 50% of global manufacturing. How did a bankrupt nation become the richest empire in history? The answer lies in understanding something the scripts about Spain, the Soviet Union, and Britain all taught us. Spain was not destroyed by silver, but by how the silver was spent. The Soviet Union was not destroyed by oil, but by what the oil failed to do. Britain was not destroyed by war defeat, but by how the victory was financed. America's triumph was different. This is the story of how a nation became rich from its own debt, and how that debt became invisible as an economic constraint. This is the story of the greatest financial sleight of hand in human history. We need to start on September 2nd, 1945, the day Japan surrendered. In the dark forests of Missouri, hidden beneath a mountain of limestone, Fort Knox held the prize. 2 weeks prior, the United States Postal Service had completed the largest movement of physical wealth in history. Billions of dollars in gold bars, transported on battleships and fast liners across a dangerous Atlantic, arrived in Canadian vaults in Fort Knox. It was a treasure of biblical proportions. 2/3 of the world's gold supply, approximately $33 billion in current value, was now locked in American vaults. No other nation possessed comparable reserves. The Soviet Union had maybe a few hundred tons. Britain had liquidated nearly every ounce to pay for weapons. Germany and Japan's gold was seized or destroyed. China's reserves were primitive. The United States held the world's treasure like a banker holding all the chips in a high-stakes game. But here's the paradox that nobody talks about. America was not truly rich because of the gold. Gold is just metal, just a medium of exchange. Genuine wealth is the ability to produce things. And in 1945, America possessed something far more valuable than gold. It possessed the only intact modern manufacturing capacity on Earth. Consider the numbers. Between 1941 and 1945, American real GDP grew from $88.6 billion to $135 billion. That is a 52% increase in productive capacity. The economy did not shrink under the burden of war production. It exploded. By 1944, military production consumed 40% of the entire economy. Yet, civilian production continued to expand. 17 million new jobs were created. Industrial productivity increased by 96%. Corporate profits doubled. The American manufacturing base expanded by 50%. All of this was financed by debt. The government borrowed money to build factories, retool plants, and train workers. But here is the critical insight that the economists missed. The debt did not finance consumption. It financed investment in capital stock that would generate returns for decades. During the war, America built 300,000 aircraft, compared to a pre-war annual capacity of 12,000. It built 86,000 tanks, 75,000 vessels, 17 million rifles, and 4 million artillery shells. But more important than the weapons was the infrastructure. Henry Kaiser's shipyards reduced Liberty ship production time from 365 days to 1 day through revolutionary assembly line techniques. These innovations were not destroyed after the war. They became the foundation of American manufacturing dominance. America created entirely new industries during the war. Radar, electronics, synthetic rubber, aluminum, plastics. These industries did not disappear when the fighting stopped. They persisted, generating returns for decades. In contrast, look at what happened to every other major combatant. Germany's industrial base was carpet-bombed into rubble. Japan's cities were incinerated. The Soviet Union's western regions were devastated by retreating Nazis. Britain had converted nearly its entire industrial base to war production and would emerge with depleted capital stock. France was occupied and had suffered years of reconstruction in reverse. Only America emerged from the war with more manufacturing capacity than it had entered with. This was not luck. This was geography plus strategy. America faced no invasion threat. Its factories suffered no bombing. It could expand capacity without fear of destruction. When the war ended, America possessed 50% of world manufacturing output. More modern factories existed in America than anywhere else in the world. The United States held 61% of total OECD GDP. Intact production infrastructure, experienced workforce trained during war mobilization, established supply chains and logistics networks. For the next 15 years, between 1945 and 1960, American goods dominated global markets, not because they were superior or cheaper, but because they were the only modern manufactured goods available in quantity. This created the first of America's wealth sources, manufacturing dominance, but the dominance was built on something deeper. While the factories expanded, something else was being engineered in the halls of power. In 1944, as the war still raged, American planners convened at Bretton Woods, a resort in New Hampshire. They designed a financial system explicitly intended to privilege American interests. The Bretton Woods Conference created what appeared to be a neutral framework for global trade and currency exchange. In reality, it was an architecture of American advantage. The system established the dollar as the world's reserve currency, backed by gold at $35 per ounce. All other currencies were pegged to the dollar. The International Monetary Fund and the World Bank were headquartered in Washington, D.C., controlled by American interests. American officials held the voting majority. American economists made the rules. Now, you might ask, why would other nations accept this? The answer is simple. They had no choice. Britain was bankrupt. Europe was in ruins. Japan and Germany were defeated. The Soviet Union was isolated and distrustful. Any nation needing to rebuild had to accept American terms because America was the only source of capital and credit. The system worked like this. The dollar was as good as gold because the United States held 2/3 of the world's gold. Other currencies were dependent on American willingness to exchange them. This meant the United States could run persistent trade surpluses, while other nations were forced into deficits. It meant America could export inflation to other nations as they accumulated dollars. It meant the U.S. could impose trade conditions on dependent nations. American corporations had privileged access to international credit, while other nations rationed capital. Between 1945 and 1975, the United States was the dominant global creditor, lender, and investor. American corporations expanded globally while protected by favorable currency arrangements and capital controls that benefited American interests. A Bank of England official bitterly noted that Bretton Woods was the greatest blow to Britain next to the war. He was right. The financial system formalized the transfer of power from London to Washington. This was the second source of American wealth, financial architecture dominance. But the most explicit mechanism of American enrichment was something darker, something that required desperation on one side and ruthlessness on the other. On December 7, 1941, Japan bombed Pearl Harbor, and America entered the war. But months before that, in September 1940, Britain was already drowning. The Nazi military machine was advancing, and Churchill was desperate for weapons. He wrote to Roosevelt begging for destroyers, old ships that the American Navy had in mothballs. Roosevelt agreed to send them, but nothing is free in international finance. In exchange for 50 aging destroyers, the United States demanded something else. 99-year leases on British naval and air bases throughout the Western Hemisphere: Newfoundland, Bermuda, the Bahamas, Jamaica, Trinidad, British Guiana. Britain was forced to surrender control of strategic positions covering the entire Atlantic and Caribbean. Churchill's own aide, John Colville, compared the deal to Soviet exploitation of Finland. Britain was coerced into an agreement that would echo through a century, all for 50 old ships that barely functioned. The pattern continued with Lend Lease. In 1941, Congress passed the Lend Lease Act. It was presented to the American public as a noble gesture of support for a beleaguered ally. America would lend Britain weapons and supplies without immediate payment. It sounded generous. The history books celebrate it as magnanimous assistance. The reality was more ruthless. Lend Lease came with a price tag written in American terms. Equipment was loaned but understood to be destroyed during war. The principal repayment was not money, but acceptance of American-dictated post-war trade rules. Article 7 of the Lend Lease Agreement required Britain to dismantle imperial preference, the preferential trading system it maintained with its dominions and colonies. Britain had to accept sterling convertibility, which would drain its currency reserves. These were not gentle suggestions. They were preconditions for survival. The mechanism of extraction was elegant. When Lend Lease ended abruptly in September 1945, just weeks after Germany surrendered, Britain faced an immediate crisis. The nation had converted entirely to war production with no time to reconvert to civilian manufacturing. Its entire economy depended on American supplies continuing, but Truman terminated the program with no transition period, no grace period, no mercy. Britain was forced to beg, hat in hand, to the nation that had been its ally. The response was conditional. Britain had to take a loan of $3.75 billion from the United States at commercial terms with interest. This was not a gift. It was a commercial transaction. Then Britain had to accept sterling convertibility. On July 15, 1947, the window opened. What followed was a financial massacre. The moment British pounds could be exchanged for dollars, the world rushed to sell them. Countries that had been holding sterling for years unloaded it to get their hands on precious dollars. The money from the American loan, which was supposed to last for years, began to evaporate. Within 5 weeks, Britain lost hundreds of millions of dollars. The government watched in horror as its reserves vanished. They had to slam the window shut. Britain was forced to devalue the pound from $4.86 to $2.80. Overnight, British citizens became 30% poorer relative to the world. Britain repaid this loan for 60 years. The final payment was made on December 29, 2006. 60 years after the victory parades, 60 years after the war ended, British taxpayers were still paying for the privilege of having survived World War II. But the most explicit example of American extraction occurred in March 1941, before America even entered the war. The British government owned a company called American Viscose Corporation through its subsidiary Courtaulds. American Viscose was the largest manufacturer of rayon in the United States. It was profitable, generating millions in annual dividends to Britain. Britain desperately needed cash for war supplies. So Treasury Secretary Henry Morgenthau issued an ultimatum. Sell American Viscose, he said, or Lend Lease will die in Congress. The British government had no choice. They seized the company from its owners and put it up for sale. Morgan Stanley and Dillon Read investment banks orchestrated a distressed sale. The British Treasury received $54.3 million. The company was worth at least $100 million. The investment banks made $7.8 million in commissions and profits. Britain had to repay Courtaulds in pounds the difference between actual value and sale price, creating additional domestic debt. A valuable productive asset that had been generating income for Britain was extracted by America. Britain received below-market payment. American investment banks profited. The asset would generate returns for American owners for decades. This was the template. Lend-Lease was a mechanism to force allies to liquidate their assets while accepting American financial dominance. Britain had fought the war to save civilization and emerged by selling its future to its closest ally. But even as Britain was being squeezed, America was making strategic choices that would ensure permanent dominance. While other nations converted everything to war production, America maintained production balance. Military production was 40% of the economy, but civilian production continued. Automobiles, appliances, housing, consumer goods all kept flowing. When the war ended, America had not just military capacity, it had civilian manufacturing capacity, ready for peacetime production. Britain had no such luck. It converted entirely. When the war ended, there were no civilian factories, no consumer goods, no productive capacity for peacetime. It had to rebuild from nothing. Europe faced the same devastation. Japan's industrial base was destroyed. Germany was in ruins. Only America had intact capacity on both fronts, military and civilian. When peace came, this capacity translated into immediate advantage. American factories that had been making bombs could convert to making cars. American factories that had been making bullets could convert to making refrigerators. American corporations had accumulated massive retained earnings during the war. They had the capital to invest in new equipment and expansion. Corporate investment exploded between 1946 and 1950. Gross private domestic investment rose from $10.6 billion in 1945 to $46 billion by 1948. New factories were built to produce consumer goods. These investments created the productive capacity that would drive American growth through the 1960s. Meanwhile, Britain and Europe faced rationing that would continue until the early 1950s. Wage controls, price controls, limited consumer goods, investment constraints due to dollar shortages. The British working class faced austerity lasting a decade. The American working class was becoming wealthier. Unemployment fell below 2%. Labor unions were strong. Real wages increased 50% between 1939 and 1944. Wages continued rising in the post-war period as labor remained scarce. Workers with rising wages bought consumer goods. Increased consumption drove investment in manufacturing. Manufacturing employment created more workers with purchasing power. Wages continued rising. It was a virtuous cycle that Europe and Britain could not match. This created the third source of American wealth, labor shortage and rising wages. But there was a fourth mechanism that nobody talks about, the war bonds. The government had sold billions of dollars in war bonds to the American public. Citizens bought bonds, believing they were making a patriotic investment. The government promised to repay them at fixed interest rates. The Federal Reserve pegged interest rates low at between 0.375% and 2.5%. It was a lousy return, but citizens bought them anyway. The government was borrowing money at artificially low rates. After the war, something unexpected happened. Inflation accelerated. The inflation was not forecast. Bondholders bought bonds expecting to earn a fixed return. Instead, they suffered negative real returns. A Series E bond purchased in June 1944 had a nominal return of 30%, paid back $130 for $100 invested. But accounting for inflation, the real return was negative 13%. The bondholders had lost money. The government had repaid the debt in dollars that were worth less than expected. Inflation did the equivalent of paying back the debt at a discount. This was a hidden tax on bondholders, mostly middle-class and working-class savers. It benefited the government, corporations with debt, wage earners whose wages rose faster than inflation, and homeowners with mortgages who repaid in cheaper dollars. The savers, the creditors, the retired people on fixed incomes, they suffered. They had financed the war and were repaid in depreciated currency. This was the fourth source of American wealth, the inflation tax, which reduced the real debt burden while asset owners prospered. By 1951, the Federal Reserve ended the interest rate peg, but by then, the real debt burden had already declined significantly. The national debt, which had been 119% of GDP in 1945, had fallen to 62% by 1955. By 1965, it was 46%. By 1975, it was 31%. The debt had become negligible. But the mechanism of disappearance was not primarily repayment. The government never truly repaid the WWII debt. Bonds matured and were redeemed in nominal dollars, but new debt was issued to replace it. The real mechanism was growth. GDP growth was so rapid, the economy expanded so quickly, that the debt became a smaller and smaller percentage of a much larger economy. Between 1945 and 1950, American annual growth rates were 4 to 5%, higher during the post-war boom. Compare this to pre-war growth, which averaged around 2 to 3%. The war had permanently increased the growth trajectory. The debt was financed at 3 to 4% interest. If the economy grew faster than the interest rate, the debt burden automatically declined. It was mathematics. It was inevitable. And the economy did grow. It grew because America had expanded its productive capacity by 50%. It had created new industries. It had a trained, full employment workforce. It had a massive global market desperate for American goods. It had currency dominance that allowed it to export inflation while importing goods. It had control of the financial institutions that governed global trade. Every source of growth was in America's favor. Every structural advantage was built in. The debt became self-paying. The investments financed by debt generated returns that exceeded the debt service costs. The factories produced goods that sold globally. The corporations that owned those factories earned profits. The workers earned wages. The government collected taxes. The economic system that the debt had built became a perpetual wealth generator. This is the lesson the other scripts tried to teach. Spain received silver, and it became a curse because the silver was spent on wars and cathedrals and court luxury. The silver financed consumption, not investment. It created inflation that destroyed competitiveness. It made Spain addicted to the flow of silver and vulnerable to any disruption. When the mines began to dry up, Spain had nothing to fall back on. The economy had been hollowed out. All the Spanish wealth had flowed abroad to pay for imports. The Soviet Union received oil, and it became a curse because the oil was spent on military build-out and food imports and subsidies. The oil financed consumption, not investment. It reduced the incentive to fix the broken economy. It made the Soviet Union dependent on the price of oil. When oil prices crashed in 1985, the entire system collapsed because there was no underlying productive capacity to sustain it. Britain fought the war and won it, but the victory was financed through asset liquidation and currency arrangements that destroyed the long-term economy. Britain had to liquidate its foreign investments. It had to accept currency arrangements that drained its reserves. It had to open its protected trading empire to American competition precisely when British industry was weakest. The victory financed consumption and reconstruction, not investment in new productive capacity. Britain repaid debts for 60 years. It declined from global superpower to secondary regional power. America was different. America financed the war through deficit spending, yes, but the deficit spending created real productive capacity. Factories were built. Technology was developed. Skills were embedded in the workforce. Supply chains were established. When peace came, that capacity continued generating returns. The debt that had financed the war became invisible because the returns on the investment far exceeded the debt service costs. This is the deepest truth about economic power. Wealth is not money. Wealth is not gold. Wealth is not silver or oil or any commodity. Wealth is the ability to produce things people want. Nations that manage debt to finance productive capacity become rich. Nations that use debt to finance consumption or resource extraction become poor. America understood this, even if it never explicitly stated it. The American political and financial leaders knew that to dominate the post-war world, they had to build manufacturing capacity. They had to control the currency. They had to engineer favorable trade rules. They had to extract assets from potential competitors. They had to create structural advantages that would persist for decades. By 1950, the United States held more than half of global manufacturing output. 2/3 of the world's gold control of the financial system that governed global trade. The nation had gone from a debt-ridden wartime economy to the undisputed economic hegemon in a single decade. The debt had not been repaid. It had been transformed into productive capacity that generated wealth for generations. This is how America became rich from WWII debt, not through heroic sacrifice or noble purpose, though those narratives were useful for public consumption, but through understanding that investment-financed debt becomes self-paying when the investments generate adequate returns, through strategic extraction from allies who were desperate for survival, through engineering financial systems that privileged American interests, through maintaining manufacturing capacity while others converted everything to war production, through forcing trade rules that locked in American advantages, through controlling currencies and capital flows, through using inflation to reduce real debt burden while asset owners prospered. The war ended in 1945. The debt was supposed to be unsustainable, yet by 1975 it was negligible. In between, America had become the richest nation in history, not through repayment, but through growth, not through sacrifice, but through advantage, not through luck, but through strategy. The debt had financed the creation of a machine that generated wealth for a generation. That is how a bankrupt nation became an empire. Subscribe now to learn how the world really works, because the official history will never tell you this story.